to talk about estate planning in the post-election age, post-election, and hopefully post-corona age. There's various things that are relevant here, and I'm very happy to be able to do this with Brian at Dunhill. He'll introduce himself as a second because there's a legal aspect of this, but of course there's a strong business and financial issue. This involves many aspects, and I'm very happy that Brian can be here today to talk about this subject. I will be presenting first and him after me. We will, questions and answers are always welcome, and questions. If you want to ask questions, then please do it not via the chat, but doing via the Q&A functionality. The chat is this one long, continuous flow of stuff, and it's better to address question one by one, like in the QA. We will be making these slides available, what else? Yes, so here we have the agenda. First of all, introductions, and then you see the other items. Brian, why don't you start by introducing yourself briefly?
Perfect. Thank you for the invite, Monty. It's always a pleasure to see you. My name's Brian Dunhill. My firm, Dunhill Financial, is about a decade old, and we started in Brussels. We've just moved the firm over to London a couple years ago to try to take advantage of some of the growth aspects that are going on. We concentrate mostly on American expats that are overseas, but we deal with other expats as well, and they all have cross-border issues. My background at UBS dealt with a lot of concentrated positions, so we deal with a lot of these types of high net worth issues of how do we go ahead and move over our estate in the most efficient manner, while maybe keeping or changing our portfolios in certain ways. So we're here to help in any way, and we always enjoy working with Monty to find opportunities to help on those issues.
Thank you, Brian. And I'm Monty Silver, a tax attorney. I've been a tax attorney for 20-some years. Some of you, a lot of you, have been to webinars of mine in the past. Years ago, I worked for the IRS when I first got out of law school in the estate and gift tax division, which is apropos what we're talking about today. And then with the U.S. Tax Court, I really enjoy U.S. tax. It's something which I find very challenging, intellectually challenging. I like the challenge of finding good solutions. And I've been involved in advocacy. So today we're going to be talking about a specific issue of quite relevant to estate and tax, and how things look today for someone who does have estate and gift tax considerations. If you don't have estate and tax gift issues, if you're not have a net worth of a few $1 million, of course, then that is less of an issue. And if you are a non-American, this is also not so relevant. We'll do a different webinar, not on estate planning for non-Americans, but that is a different show today. So this is what we're going to be talking about today. And what we talk about does not constitute legal or financial advice. We are doing this as a service to educate people at the high level, but nothing here is to be relied on. Having said that, let's start with what the subject matter is today. So first of all, we're talking about U.S. Okay, so who is out there and why are you listening? You're either a U.S. citizen yourself or married to a U.S. citizen, and you have a net asset value of a few $1 million individually, $5 million, or as a married couple, $10, $12 million. And you're wondering, what can I do to maximize my situation in terms of avoiding U.S. estate tax? So you're either the U.S. citizen or you're the tax preparer of the U.S. citizen, the CPA, who has these kind of clients, and they're asking questions. Okay, so first of all, what the estate and gift tax is, it's a unified gift, meaning it applies again to U.S. citizens, to the worldwide estate at death, plus taxable gifts made during life. Okay. Okay, so what you own worldwide at death is quite easy, but what is a taxable gift? A taxable gift is defined by the code, anything in excess of $14,000 or $15,000 a year to anyone you want. You can gift to any individual an amount which is not taxable every year, a small amount. And if you're married, both of the couple can give to that person to $14,000 a person. Also not taxable, and this is something that Brian will talk about, are contributions to charities. There are a bunch of issues which we can dedicate entire webinars, and we may do that in the area of charity giving. Brian will talk about that a bit later on the financial side, but the legalese of these matters, such as charitable contribution, are so significant in and of themselves that as a lawyer, I'm trying to provide a webinar which is on a specific issue. But again, charitable contributions are not taxable if done correctly. So we're talking about estates and gifts up into the exemption of today, which stands at about $11.5 million, which reverts to $5.5 million in 2025. Okay, that is per person. And for each US, if you're married to an American, then that person also has $5.5 million. So together, excuse me, $11.5 million today. So today, as it stands, if you are a US person, married to a US person, and you have a net asset value or a net value of $23 million, as things stand today, and your will allows for the proper allocation at death, then you are entitled to, you wouldn't pay estate tax for an estate worth south of $23 million today. Again, that will be half that amount in 2025. And of course, there's been the elections, and the Democrats were not major fans of the increase of the estate tax from 5.5 to 11 under Trump, and so we don't know what the exemption has in the future. We'll talk about it in a second. And of course, the estate and gift tax are based on the value of the property at death or at the time of the gift. Okay, so valuation, of course, is a key topic which we'll talk about. So the basic question is very clear. I'm a US citizen living abroad, and I have a net asset value of about $6 million, or 12 if I'm a couple. What do I do to make sure I don't pay anything in estate and gift tax? Okay, and this is especially if you anticipate the assets to increase or greatly increase over time. And we'll explain that because, again, if you pass away with assets which are worth 3 times what they are today, then that generates greater estate tax liability. Okay, and you want to avoid that to the extent you can. So we're talking about a certain level of clients or American citizens, married, not married, and the type of assets, will they increase over time? If it's cash, that's one thing, but no one holds that much in cash. If it's real estate, we'll talk about the scenarios. And what I can say almost categorically is as follows. The answer to that above question is probably to gift away non-controlling interests in the assets, okay? And this achieves 3 important goals. Number 1, beneficial valuation, for 2 reasons. Number 1 is, in the future, if they go up, it's better to give it today and not exhaust a bigger chunk of the exemption that you have. Number two is Corona, where the values may be lower. We'll get into that later. Number two is the benefit of gifting away is that you're transferring assets out of your estate. Okay. Number three, maintaining control. Everything that we talk about today, we're talking about minority interest, even though, as we will see, minority can mean giving 50% to one child and 50% to another child, and still that can be considered a minority in certain situations, but that's of course an extreme case. And optimization of time. We choose when we want to give. We know what our life cycle looks like, and we're not giving away everything today. We're giving small pieces, but the the giving of non-controlling interest in assets, certain kind of assets especially, can really achieve those goals at a very, very insignificant cost. Okay, so the keys that we're talking here about, the key variables, so we'll say it like that. The key variables to what we're talking about, the gifting away of minority interests to next generation, is there's quite a few variables. First of all, the nature of the asset, and is it transferable? Okay, there's a big difference between $5 million of cash in the bank and shares held closely in a family corporation where you don't really know who might buy it. The big difference in the type of the asset. Okay, real estate, we'll talk about that in a second. Next issue is control. How do I do this but maintain control as I want to maintain control over time? Marital status, children, am I married? Am I married to a U.S. person? Do I have children? Are they U.S. persons? How old are they? Might it be worth their while to give up citizenship if they're younger than 18? There's all kinds of questions like that which have to be answered. Another issue, which I will not discuss today, but again may be subject to a future webinar, is the issue of trust if they're too young. If you want to create trust, charitable trust, and reap some of the benefits there. The issues of trusts in and of itself can be the subject of 3 webinars. You have grantor trusts under the code, you have non-grantor trusts, you have irrevocable, revocable, U.S. trust, non-U.S. trust, a world unto itself. But if you are U.S. citizens, the issue of U.S. taxation on trust and contributions to trusts are significant and really narrow what you can and cannot do. But again, this is beyond the scope of today's conversation. Maybe Brian will mention something on this, maybe not, maybe on a high level, but as a lawyer, I'm really trying to focus in on what I can talk about today in order to convey value. Okay, so key issues: the type of the asset that you want to maintain control. Are you married? Yes, no. Children? Yes, no. Are they Americans? How old are they? Okay, citizenship, as I said, one thing that is another really brutal thing that you must avoid is gifting and then giving up a citizenship. Okay, bad idea. And it's another issue. I'm not going to talk about expatriation and the impacts of there's exit tax, there's section 2801 that very few people know about. It's a bad trap for people who are thinking about gifting and then expatriating. Anyways, these are very core issues. Of course, local law. I can give you the best solution in the world for America, for the US, if you're an Israeli or if you're a guy in London, as Brian lives in London. But if the laws of the UK or Israel are such where what I'm saying to you as an American makes no sense for local implementation, then I've really done you a bad disservice. Because every aspect of this has to, even if it's 100% fine, you want to verify that it's 100% fine and there is no gift tax or estate tax, which is not the truth in France, UK. So you must address, these are the key issues that go in, and we'll narrow them down because I think we can effectively narrow them down. Okay, so let's say though that I have an asset. okay? And we're not talking about cash in the bank, and we're not talking about stocks in publicly held companies. Because if that's what you have, then the issue of valuation, at least, is not that relevant. Because what would a buyer give a seller for that stock? Well, what's the quote of the stock today? Cash is cash. There's no valuation issues, okay? And why are we talking about valuation? Again, because what your estate is worth for U.S. estate and gift taxes is what the asset is worth on the date of death or on the date of the gift. So valuation plays a key function regardless, okay? So that's why I'm saying if it's cash in the bank or a publicly traded stock, you can get a pretty good idea of what it's worth, okay? Now, if you hold that today, you think it's going to appreciate and you want to give the gift today of that stock, that's one of the things we're talking about. If you're a shrewd investor and you play the stock market well and that's been your business and you have stock, then gift tax may be something worth considering. And if you don't want to give away stock and you want to maintain control, then again, these are some of the things that do face you. But in terms of valuation, the definition of valuation is pretty simple. What a willing buyer and a willing seller will pay, what a willing buyer will pay a willing seller in the arm's length transaction. Okay, I want to buy that car, I want to buy that company, I want to buy this building. What will a person pay for it? Okay, so obviously, if it's stock or cash, I know what I'll pay for it. But what about if it's real estate? How about if I'm building a project? How about if I'm in construction? How about if I'm buying a new place out in a luxury house in Switzerland in the mountains? Is this something that I want to do? So how do you value those kinds of real estate? Okay, much bigger question. But the real core of the presentation is this slide. And we'll spend about 10 minutes at least on this slide itself, because this is really the core of the presentation. So what we're really talking about here is not money in the bank or stocks, publicly held companies. It's people who have accumulated wealth, and the infinite scenarios that you do. You can be a partner in a law firm, you can have exited in high tech, you could have inherited money and now whatever, you started a retail company, you built a the infinite variation on this on the theme. It can be a company that's an operating company. It can be shares in a partnership with a law firm or any other. It can be shares in LLCs, which are basically closely held companies. So we're talking about assets which are there's no available market for them. And the determination of valuation is very, very ambiguous, as we shall see. Okay, so again, we're talking about shares in entities which own real estate, which own a business, etc., that you have you or your client has a significant interest in, and you're thinking of how can I avoid U.S. tax, okay? And as I said, there's infinite scenarios, and you can ask questions QA in QA. I see some people have already submitted questions. Okay, so the question is, what is the value of that interest in this closely held corporation, partnership, LLC, whatever, okay? And so what would a willing buyer pay for? So if you're selling everything, if I'm selling this building, if I'm selling my entire company, if I'm selling my partnership interest in a law firm, I can sell it to what the other partners will pay for it. There's comps. If it's real estate or if it's a business, there's a way to go to a very reputable appraisal and get an appraisal. Okay, that's if you're selling the entire block of everything. okay? But that's not what we're talking about, because we're not talking about estate, exiting your business. That's not what this presentation is about. This is maintaining your business, but starting to think about the next generation, or what's going to happen when eventually you pass away and you have all, more than 6, 7, or 10, 11, 12, $13 million of net worth. So, and here is really the core, because you can get an appraiser to appraise real estate and appraise a corporation or a company or the value of my investment in real estate, okay? But that only goes so far in terms of valuation, and that is a very central issue here. And I'll give you very concrete examples to drive this home, as they say, okay? I have this business, I'm a construction, okay? I'll sell all the company for $100, $100 million, okay? But what is 1% of that company worth? You'd say $1 million, and I'd say no, not for purposes of estate tax, for estate tax. No one will pay, or for any purpose, no one will pay you $1 million for 1% of that company. Why? Because let's say the owner never distributed the dividend in his life, and tomorrow sells all the assets and draws himself a huge bonus every year and you as a 1% owner get nothing. So obviously a 1% interest is not worth, for fair market value, is not worth 100 of the asset. That is called a discount factor. And discounting is that's basically a very broad area. The one case that I had at the IRS years ago was with the deceased owner of the Boston Red Sox, who owned also Fenway Park, and this was granted. I mean, this is a few years back, but that landed on my desk for minority discounting when Gene Yawkey died, and I spent the better part of a year just on that alone. But she took everything I'm talking about now is what she did. Trusts, charity, minority shares, because she started giving minority shares into trusts for various people, various charities, and what have you. And she, of course, did a very, very good job. And the family is extremely wealthy, but the discount factors are the same. And the question is, what is reasonable to justify in these discount factors? So again, we're talking about the transfer of minority shares. That's what the whole presentation is about. The transfer of minority interests in these assets to other people, okay? If it's to, we'll talk about if it's to an American or not, we'll just touch upon briefly. But obviously, if you can transfer it to a non-American, then that is out of the estate tax world anyways, because they're not Americans and they don't pay estate tax unless that business is an American, it's an American company. But most expats have their businesses abroad or their wealth abroad. So we won't get into that distinguishing factor. But going back to discounts, okay, so 1% is not worth $1 million. How about 49%? It depends on how many shareholders there are that hold the 51%. But if it's one person who owns 51 and you own 49, and you just bought into a minority interest without any protection on veto rights or anything like that, then you're not too happy. And that share is not worth 49%. I wouldn't buy it. What would a willing buyer pay for that interest? For a 49% interest, he has no, he or she has no control of the board and no influence on bonuses. That's not a good situation to be in, and it goes back. What is the value? Okay, so that's a discount factor, okay? Or next discount factor, I'm going to give shares away, but let's say I have a lot of US real estate that I'm invested in, through LLCs. Can I transfer that LLC interest? No, and even if I can, it's subject to extreme regulations of the LLC operating agreement. If it's a family-held business and my father gave me 20 shares, but I can't do anything with them other than sell them to my brother by contract, that is a significant restriction, and therefore that's a discount factor. What we're saying is, how can I make a gift of my $100 million company, and where on the books it may be worth 1%, but for IRS estate and gift tax purposes, a totally different way of defining value and worth, it is worth much less. And this way I can give away much more. Again, and the person I'm giving it to, or the trust, or not US beneficiaries, then all the better. So that's another discount factor, okay? And the other one is, of course, the kinds of shares that you give, or the kind of interest. Does it have voting rights or not voting rights? Again, when we're talking about gifts, we must assume that you're giving the gift. You cannot give a gift of 100% B series shares, which just convey some kind of future rights. No, you have to give the gift. Okay, there's no ifs, ands, or buts. It has to be a gift. And if it means giving to an irrevocable trust, that means giving to an irrevocable trust or charity. But it means giving the gift, but in a way that rather than being valued at X, it's valued at substantially less than X, and therefore you can give away more and therefore not end up with as much as in your estate. Okay, so these are all very important. Really, the crux of this presentation is, how do I give away in a way which suits my needs? And the answer is by this kind of gifting of non-control minority shares in anything. Yes. Now, what is the IRS position? The IRS position, and I can say this, many areas I don't see, much disputes in, but in the area of valuation of estate, I've seen them challenge anything from $20,000, $30,000, $40,000, and I mean this. You guys know I wholeheartedly. The issue of valuation is also a factor of maybe two things: how much money we're talking about and where the assets are located, and where the shareholder is. So we're talking about millions of dollars. Oh, you've got to believe that they're going to at least ask for valuations or appraisals, and especially if there's been whatever. Okay, so this is an area where, especially when we're talking about millions, you got to, of course, know what you're doing, and that getting an appraisal and all that kind of stuff is very important. Or a comps, and the IRS will challenge, or not even challenge. They'll just ask, in a sound, not just in a basic audit, to justify these things. So, from a pure tax basis, I can say that the numbers are large, the planning opportunities are large, but the IRS is also looking at situations such as this, and yeah. So I think that's, oh yeah, okay, one last thing, and I think this is, okay, two last things, and then I'll end. Yep. Is the corona factor. Okay, basic question. Well, what is the impact of corona on valuation? Well, has corona impacted your business? Has corona impacted your industry? Has corona made it less likely that you'll have a buyer? Therefore, the valuation is less. What would a willing buyer pay a willing seller? And if in corona that is less for your business, for your industry, or in general, then that is especially a nice little trigger to this planning. And what is valuation in the eyes of the IRS during corona? Well, you know what's happening in the United States, and you know that a lot of people, and I know for a fact, are taking advantage of these specific issues throughout the United States now. The U.S. is a shell-shocked, IRS is shell-shocked, the CARES Act and that they passed $2 trillion. This is an issue to take into account in any kind of planning. And the last slide is the future of the estate and gift tax. And it reverses, as I said, back to 5.5 million in 2025. Now with the Democratic administration, they didn't like the increase of the Tax Cut and Job Act. And then there's the issue of retroactivity of gifts. I personally don't believe that would happen, but the fact that I believe or don't believe, if you're sitting on $50 million today and you're 70, 80, you may not want to take the risk of, is the tax potentially retroactive, by which I mean today. Today, the exemption is $11.5 million combined. So let's say you give today in a gift $11.5 million, and tomorrow the law changes back to 5.5. Can the IRS go back and say, no, we're looking at the exemption at the time under the new law? The value stays the same on that time, but the exemption has changed. So that's, look, the IRS, I'm challenging the Treasury. The transition tax was ruled, which went back 30 years and taxed corporate earnings for 30 years. They found that is fine to do, that retroactively is not a problem. To go back 30 years in the case of transition tax. Is that the truth? The same for the estate tax? Much bigger issue, because there it affects people and whatever. But nonetheless, if you're sitting on a $50, $60 million estate, then those are something to consider. Anyways, I'll end here. And I see there's been some questions. So let's begin. 1 second. Okay, so yeah, so a question about the minority discounting. And this kind of, so it's a kind of a long question, but that's very, very fact specific and touches upon the question that goes into the detail of a specific act. I really can't answer that right now. But okay, another question. Eric from Arrow, hello. There's a U.S. bilateral estate and gift tax treaty. Okay, so what I've talked about right now is what the question relates to is tax treaties and between the countries on estate tax. That is a whole different area and a very good area that I didn't even bring up, and that's the old issue of the treaties. You have the local law issues, and one other issue is the issue of treaties between America and the United States, which imposes where does the estate tax for people who have dual citizenship or even not apply for a person living here for assets over there, and what about if it's a U.S. citizen? I know, and in general, France has a very aggressive estate tax by itself. So all the issues of treaties and where you live is such an integral part of this if you happen to be in one of those countries which does have an estate tax, yes, that is beyond the local law. You have to look at the treaty, or you have to look at both of them. And you're saying here it's 60%. I don't know. I don't know what the treaty, what the French tax is. But again, that just sort of goes to show the complexity of this issue when you, of course, put on the treaty as well. It's something that you have to take into account. The quality of the evaluation. Look, okay, so it's hard to say how. The question is it how important is the appraisal in the process, and that's it's like saying asking how long is a stick. If it's cash, is it real estate? Is it worth 100 million? Is it worth 5 million? If these things are very fact specific. I know just from practice, when you're talking about an estate that's worth tens of millions of dollars, or a business that's worth tens of millions of dollars, privately held business, retail franchise, something in that world, and it's worth in the tens of millions of dollars outside of the United States. I would think that, where the people, and this is a key factor, how conservative are the people? If the people who own these assets are conservative, which they many times are, and that I think Brian will touch upon also in a second, we're not necessarily looking on one hand at people who are great risk takers, because they're older people, and for them to spend $20,000 on a top of the line appraisal, I would not move actually without something of that quality for them, because I see right away that they're conservative, and I am going to be conservative. I'm not going to, for another $20,000 for a good appraisal, that's worth its weight in gold, because once the IRS sees something like that down the line, it's game over in so many situations. So you really got to know the grantor, or the person who owns the assets. And this is, as a lawyer, a tax lawyer, I come and solve a problem. This is a very good way to hand it over to Brian. I solve a problem, I set it up the way it should be set up, looking into all these different aspects, but then it gets into managing the money and managing the things, and the long-term relationship of CPAs and brokers and financial managers. And that, I think, is a very good key for me to stop talking. There's a few more questions, but I'll stop. I'm also thirsty now. So, but yeah, I'll get back to the other questions. But the relationships and things like that is a good way to transfer it to Brian, and the floor is yours.
Ah, perfect. Thank you, Monty. I think that is a fascinating way to end, because I've spent the last 20 years always assuming that estate tax exemptions will go down, and I've been wrong for 20 years straight. And here we are yet again predicting that they're going to go down. So I think it shows your skill, that you're looking at planning for the worst and hoping for the best, and hopefully come 2025, we're not having to deal with huge changes, and we're not having to deal with losing some of those gift exemptions. But even gifting, we get the growth already passed over, even in that worst case scenario. So it's a nice place to be planning right now. Now, in the planning process, naturally, end of the year is that opportunity to make a little bit of a clean inside of our portfolios, and to take advantage of as many of these tax deductions as we can. Some of these are the obvious ones that you should be doing every December, like harvesting any of your losses. In a year like 2020, you probably have some great winners in your portfolio, and maybe even some big losers in your portfolio. There's lots of consumer discretionary stocks and the likes that got battered with coronavirus. And it'd be a shame that just because we expect them to rebound, that you don't take the tax advantage by selling them off in December. Now, that's easy to do because you're able to carry those forward as many years as you would like in the future to offset against gains in the United States. But when we're expats that are abroad, we do have to make sure that we're looking at the local laws. So for instance, what we don't want to do is we don't want to sell a position that will be a net loss in dollar terms on our US taxes that might be a gain on our UK taxes. So we need to make sure we do the calculations and that we offset those two sides. On the other side, as Monty brought up, we have a change of administrations. I think it's pretty conventional wisdom that we would expect a higher tax bracket going forward, especially with some of those brackets when it comes to to capital gains taxes. And so 2020 might be that opportunity to take advantage of some of these lower tax brackets. And if they don't change, well, we were preventative, and that's all the better. So if you have some taxable gains inside of your account, and yet you have some wiggle room to where you're not at the highest tax bracket, it might behoove you to realize some of those gains a little bit earlier on. Same thing when we've got these tax credits between countries. We want to make sure that we realize them and that we look at how our taxes are going to be affected on both sides for those credits. But where you're going to get the most bang for your buck, because hopefully the most bang from the buck is not from losses in your portfolio. It's going to be gifting assets to that next generation and making charitable contributions. So that's where I really want to focus today. These are the things we need to do before December 31st. If we go to the next slide, we have the next slide is going through.
Yeah. Okay, and I just want to point one thing on the gifting side of it. Is what is a transfer of a share or a 1% of the company? It's basically a shareholder writing a very simple agreement and conveying an interest in a share. It's not a great formality to do, so it is something that can be done. Yeah, pretty informally and quickly.
Exactly. For our customers in Belgium, for example, they have a 3-year rule. So we just have a little 1-pager to gift over. As long as the client survives 3 years, there's no problem. If they want to gift it away right away, they pay 3%, they go down to the notaire. So it differs per country, but yeah, it's a simple process to do. Now, to me, the most bang for our buck for a lot of clients, especially Americans are extremely charitable. We donate nearly 4% of our salaries per annum, which is a multiple many times over the next most charitable countries. And you can see 69% of these charitable donations come from individuals. So this is something that is on the forefront of most people's minds. And we want to think about it and how we can do it in the most efficient ways, especially during times like coronavirus, where a lot of charities are struggling. They're struggling to meet their payroll. They're struggling to actually get some of those assets coming in. So we can talk about turning an individual donation into maybe something larger and differential. So this gives you how much charitable giving has grown. And if we go to the next slide, you'll see that there's a couple ways that we can think about tax donations in the best of ways. Now, all the way on the left, you'll see by making a cash donation, just writing a check to your favorite charity, essentially you're getting a nice big deduction if you're in the top tax bracket in the United States. And so therefore, to give $10,000, it's only really costing you $6,300. But if we use low basis stock, all of a sudden, our benefit is so much higher, it's costing us much less to give that much more. So because you give a $10,000 stock over to the charity and the charity does not have to pay capital gains on the growth that you had, and yet you get to deduct the full amount of the value of the date that you gave it, you're getting that higher benefit from gifting stock. Most charities have some sort of an account that they can receive these stocks. And if you're in love with that security, let's just take Apple, for instance. If you bought Apple years ago and you still want to own Apple shares, you gift the Apple shares. You don't even have to wait for the wash sale rule to apply because it doesn't apply for charitable contributions. You can buy right away $10,000 worth of Apple shares, and now you have a basis of $10,000 instead of maybe $5,000 or $2,000 on those Apple shares. So the first place to gift that's much more efficient than just giving cash is actually giving some of those low basis stock and using it as an opportunity to move around your portfolio. Now, what happens if you're trying to build more of a long-term plan for your charitable giving? Maybe it's your tithes to your church. Maybe it's a charity that you want to make sure that they can really build on that. If we go to the next slide, we can see that we can build donor-advised funds. Now, there's small local groups or religious groups that you might be giving into, and otherwise you can be setting up more of a charitable remainder trust or a foundation, depending on your needs. For instance, charitable remainder trust allows you the opportunity to draw an income from that money while you're living, to really let that money go towards those charities when you pass away in the most tax efficient manner. Whereas a foundation is more a formal way to control these. A local DAF is a way that you can efficiently gift that money, get the deduction for this year. Maybe you have a big tax year here in 2020, you give a large contribution to that DAF, but you decide where the money's going to go in sequential years. So next year, the year after, the year after. So you give, you can let those assets continue to grow, and you grant it as you want each year. So again, it's all about how do we control those taxes for charitable gifts that we want to give away. This still works in many ways when you're in different countries, but you'll have to work with the different countries' rules to make sure that you're gifting to 501c3s. So for instance, in Belgium, King Baudouin has a foundation that actually has a 501c3, and they have relationships with a lot of the different charities inside of Belgium. In France, for instance, a lot of the churches have relationships with an American church. So you can donate to the American church and they can get most of the funds over to your French church. So there's different solutions to make sure that it's the most taxable, tax efficient way in both your local country and in the United States, while contributing to those groups that you have. So great way with donor advised funds on those. Now, most people don't have the luxury of giving all their money away to charity. And yet the affluent typically end up having too much of their money in too few securities, either because they were the founder of the company, they bought in early, or they just bought into the S&P 500 and they ended up with a huge portion of Facebook, Apple, Amazon, Netflix, and Google. They're our best performers over the last decade, and they've taken over many of our portfolios. So if you're trying to take some risk off, now all of a sudden, most financial advisors are going to say, let's diversify. Let's not have all of our eggs in one basket. The main thing that I want to get across to you in this slide, I don't want to sit there and break down every single strategy. I want to basically say selling all those positions, incurring the taxes, is not the most efficient way to do so. It's one way of doing so. But there are several different strategies, including derivatives, forward contracts, or if you have a large enough position, pulling that into a bigger group so you can diversify it out without having the taxes. That will be a much more efficient way to reduce your over concentration in one large position. So if you put money into that donor advised fund, you don't have to worry about that. It's moved over into the charity. You can diversify it however you want to without any tax. But when we've got money in our individual names, or when you gift it down to the next generation, gifting money from one person to the next, the one disadvantage is that our cost basis doesn't step up like it does when we pass away. So you gift it to your child, now they've got a low basis stock. Now we can be looking at these types of strategies to work with. The last thing that I want to cover in the last slide, and then I'll pass it over to Monty for Q&A, is that we should be focusing on retirement accounts. Now, when they're retirement accounts in your home country, many of those are going to be due at the end of the calendar year. So you need to be thinking about this in the next couple of weeks. IRAs, Roths, SEPs, solo 401ks. One thing I want to concentrate on is if you're an entrepreneur outside of America, you still have the opportunity, if you don't have a local pension, to set up a US pension. This is a huge advantage for a lot of high net worth individuals that are small business owners. And even better, if you're talking to Monty and you're trying to discount the value of your company, you go for the last strategy. You build a defined benefit scheme, i.e. you have a law firm, you're one of the practitioners in there, you put in a defined benefit scheme that's a good retirement account that's going to cost the company a lot of money. That devalues the value of the company right now because there's a large liability in the future. A wonderful way for you to go ahead and isolate part of those assets, grow them tax deferred, but put a liability on your balance sheet. Also, because of the Retirement Act of 2005, we have the ability that when you decide to retire, to roll that into an IRA and reduce the costs of managing that and get the benefits of the IRA. Before you use any of these strategies, you want to evaluate two things. First of all, where you currently are. Second of all, where you plan to retire when you're going to use them. Some countries, like Canada and the United Kingdom, IRAs work the exact same way as the local vehicles, the RSPs in Canada and the SIPs here in the UK. Other countries like Germany and Spain make it very hard to get money out of an IRA without being taxed to death by the local regulators. So you want to have that in the back of your mind because that might push you towards using that country of residence retirement scheme instead of a defined benefit scheme in the United States. But always to manage the value of your account, of your company, and to try to defer as many assets as possible.
Okay, thank you very much, Brian. There's a bunch of questions here. Some of them impact both of them. I'll ask. Okay, so there's one I'll answer first of all because there's a few questions on this. Does the estate tax include things like ETFs, or that's one question, real estate that's owned in America? Yes. The answer is of course yes. If you're an American citizen, it's your worldwide assets. It's ETFs and all that kind of stuff. That's for non-Americans who want to avoid the US tax, and we're not talking about non-Americans here. A question about, Brian, questions around American tax issues, PIFIC. You know, what do you do, and FBAR FATCA, there's some questions here around that. So if maybe just on a high level address PIFIC, FATCA, how that impacts what an American can invest in.
Definitely. PFICs, to me, I've never seen a situation where I can't buy something that's very similar to the European product, but buy it in the United States. When I buy it on the New York Stock Exchange or any product in the United States, all of a sudden we've avoided all PFIC issues. You don't have to do an FBAR because it's a US-based account, and we're able to invest in that way. Now we make up for that on the other side by making our portfolios more currency centric to where we're going to need the money. So for instance, if I've got a client in France, I want to build a portfolio that's made more of European equities, European fixed income and the like, so that we have less currency risk, but I'll buy all those securities in the United States so that we'll avoid those EFIC issues over there, i.e. we don't want to overcomplicate it. Now, sometimes we'll end up having somebody say, I've got this structured product and therefore I'm able to do this, that, and the other of this derivative through Goldman Sachs. Well, guess what? Those would be considered a PFIC if we buy them through Frankfurt or London. We can just go to Goldman Sachs in New York and have them issue the exact same product, or somebody else do so. Yeah. So again, keep it in the United States to make your life a heck of a lot easier.
I understand, and I really appreciate the differences of approaches here, because from a U.S. tax planning perspective, you know, and compliance, I know that some of the questions here were asked by CPAs, and we're obsessed with PIFIC. And, you know, the employer who wants to invest in a mutual fund or whatever, or any kind of, even like my pension is a PIFIC conceptually. So, and those are compliance issues, but Brian, of course, looks at it from a whole different perspective of let's avoid that whole issue with the financial, and those, that's, you know, I don't see that. I see more of the more compliance side, but you're right. If, it's better to avoid it and invest in Great American mutual funds and stock, you know, like, just to avoid those compliance issues, of course. Yeah.
Exactly.
Yeah.
And those pensions, while they're technically PFICs, those European pensions, they're technically PFICs. We've also never seen the IRS go after a pension that's not been reported as a PFIC. So all of a sudden, it's...
Yeah, well, here I want it because there are most people don't even know, but it is true that the PFIC regulations exempt a large amount of foreign pensions which were related to employment. And from the reporting of the PFIC, what happens when you sell it later on? So there's a lot of misinformation, and I really don't want to even go down that avenue because, again, we're talking about very specific. I have to be very specific in what is said, but yeah. So this just talks about the complexity, you know, of the issue. Okay, another question that was asked of me, and we have 5 more minutes, and then we'll call it a day. Is Section 20, the whole issue of, I'll go back here and just put on the slide. Oh yeah, okay, the expatriation. How is expatriation related to this? Very simple. Because there's one, if you expatriate, there's an exit tax complexity here on a deemed sale, number one. How does that just adds a level of complexity. Number two, some treaties still have the 10-year expatriation issue where if you have expatriated within 10 years and you're still treated under that tax regime, so that's another complication. But the one that as a lawyer, and I read the law and I see the law, there is a law, Section 2801, which very few people know about, which says this: if you expatriate and are worth more than $2 million when you expatriated, and then you become much richer and you give gifts or pass away, anything you give to a U.S. citizen by will or by gifts is subject to an immediate 40% estate tax, period. And it has not been enforced yet, but it has been on the books for it's a law, and the IRS is working on, granted, some complex issues on it. But the issue, so that's what the Section 2801 says, that if you are worth more than $2 million when you expatriate, become extremely rich thereafter, without regard to America, give anything to an American citizen, your child or your wife or your husband, immediate 40%. So anything to do with gifting must take into account this expatriation tax. There's a certain exemption if you give it up in this country where anyways, very complicated stuff, and it has to be taken into account. We have one more minute. Okay. What do you think will happen with the estate tax now after the elections? I don't answer those kind of questions. Brian, your position was it keeps going up.
Like I said, I always, pragmatically, I've always thought if you ask people, would you rather pay taxes when you're living or when you're dead, they'd all answer it as saying, I'd rather pay taxes when I die. Yeah. So therefore, the exemption limit should go down. I've been wrong about that for 20 years. I expect to continue to be wrong until potentially one day I'm right. Yeah. So I'd agree with you, Monty.
Yeah.
speculation game.
It's speculation. And people ask me on guilty and transition tax and my lawsuits against the government all the time. I don't know. I don't speculate. I don't give opinion on speculation. I need a client with a fact pattern in front of me to address a specific issue. It's just the nature of the beast. What I can say from experience, though, is this. People that have 70, 80 million dollars, 100 million, 40 million, they don't want to take, if they can avoid and plan around that in a way that solves all their concerns, and they're conservative in 70 and 80, chances are they're willing, they want to avoid that risk and plan around it if there's a good solution, okay? And that's, I think, probably the smartest thing that I've seen from experience. It depends on who the person is sitting in front of you, of course. I think that's where we'll end it for now. I thank you all. Brian, last word. I'll give you yours.
Hey, thank you so much, Monty, for hosting today. And let us know, everyone, if you have any questions that we can help before this December 31st comes to an end.
Okay, thank you. And we will be distributing the presentation to you. Okay, thank you all very much.
Thanks, Monty.
Bye-bye.